Welcome to Alternative Investing. I'm Mark Bunting with my co-host David Kaufman. He's the president of Westcourt Capital. Now, this is the show where we shift our focus away from stocks and bonds to explore investment concepts that help you break away from the pack and potentially capitalize on some big gains. Now, today we'll be looking at multi-strategy hedge funds. And David, I think a lot of people would have the question, what exactly is a hedge fund versus a mutual fund? How do they differ?
Right. Most people are quite familiar with the concept of mutual funds known in their portfolio. Essentially, a mutual fund is a long-only approach to investing in publicly traded equities. So they can have different exposures at different times, but they can't adopt strategies to mitigate risk in down markets the way that hedge funds can. And so what hedge funds try to do is they try to limit their long exposure to the markets in an effort to extract alpha, meaning manager skill. And so what they're seeking in a hedge fund with varying strategies, which we'll talk about today, are absolute returns. The idea that irrespective of the direction of the market, that they can still, using the alpha that they have, the skill that they have, make a profit. And in order to do that, there's three key differentiators between mutual funds and hedge funds that are commonly discussed. And they are, number one, the use of leverage. Number two, the use of short positions to either mitigate risk or enhance returns, so that you could be long the market a certain amount and then short specific securities or the entire market if you're long in a specific area. And then also the use of derivatives, which can be options and futures and other types of more complex instruments. And again, the concept is that when you employ those three things, that you're able to not make macro directional bets, but make specific bets using the skill that the manager has in order to extract those special returns.
Now, within hedge funds, there are many different strategies. Give us some of those.
Sure. So a hedge fund strategy is basically the way that the manager affects his skill or her skill in order to get those returns. So examples of strategies, the most popular one, especially in Canada, is equity long short, which means that to some degree that manager is long equities and short equities at the same time. The most common strategy in that regard is the 130-30, where they're 130% long and they're 30% short, the concept being that the 30% short might mute returns in a raging bull market, but will also mute losses in a bear market. And you can also have market neutral, where you have 100% long and 100% short, in which case if there's no skill, they'll break even every year and they'll even lose because of the management fees. But if there is skill in picking both the longs and the shorts, you can have returns usually in the 6 to 8% range. Then there's credit long short, which is similar to equity long short in that it can be directional in either direction depending on where the manager perceives the market to be going. And they can hedge out specific risks and be left with pure plays, so they might be able to, as what is called, clip a coupon in a convertible arbitrage strategy where they don't worry which direction the stock goes in. They want to get the preferred return. Event-driven is, say, merger arbitrage or distressed situations. So one company announces they're going to buy another company. They'll go long on the company that's being acquired and short on the company that is doing the acquiring, hoping that everything happens as planned,
right.
And they can have a small increase. The problem with event-driven can be that if bad things happen, it's called negatively skewed. It's very difficult to make more than you expected in that strategy, but it's unlikely but possible to lose a lot less.
And statistical arbitrage?
Yes, statistical arbitrage is usually referred to, or it's complemented with quantitative analysis, so that it's the identification of mispriced securities, often using very complex algorithms, and so that they will go long a security that is underpriced, and they'll go short a security that is overpriced, expecting the prices to converge with mean reversion, so that in the end you will make a profit in both directions.
Now, the difference between strategic investing and tactical investing, define that for us.
Strategic investing is sort of generally associated with the concept of buy and hold. So the Warren Buffett approach to value investing, which is you take a very long time frame, you go long only, and you're value oriented. So that is both bottom up and top down approach, fundamental analysis to pick stocks and go for the long run. Whereas tactical investing means that the manager is able to look at a period of time, and it can be microseconds in the case of high-speed trading, or it could be weeks or months rather than a 20 or 30-year time horizon, where you can change how it is that you expect to extract alpha from the market. And tactical can be inside a strategy, so that one month you might be long sugar and the next month you might be long cocoa. Or it could be between strategies where one month you're using credit to make money and the next month you're using equities or commodities to make money, depending on where it is that you think that the money is to be made.
So there's so many styles and ideas out there. Now we're going to be talking about multi-strategy hedge funds with our guest later on in the show. Give us a primer on that.
Sure. Multi-strategy typically means that the manager is able to adopt, change on the fly and adopt different strategies depending on what the market provides him or her. And again, they can do that within a strategy or they can do it among strategies. A fund of funds can do the same thing where they hire different managers depending on what the market presents. But in a multi-strategy fund, there's one manager making decisions on the fly to decide which direction that they can go on.
So, David, what are the advantages of multi-strategy? What are the disadvantages?
The advantage of a multi-strategy, the main advantage, is that you're not limited to a single strategy. So that if someone, for example, has a single strategy of long-only equities, they're not going to perform very well in a bear market. They might not perform as badly if they go to cash, but they're not going to profit from the bear market. Also, the investors benefit from intra-fund diversification, so that they might be wrong on their equity picks, but they might be right on their commodities picks or their options picks. And then there are disadvantages as well, which is that you have operational risk in a multi-strategy fund where that manager has to be right a lot of the time because you don't have diversification among managers in order to achieve the muted downs in the case that one of those managers turns out to be horribly wrong.
All right, David, a lot of good and interesting information there. There was a quick lesson in hedge funds. After the break, we'll talk to a pro about hedge fund strategy. Stay tuned. Welcome back to Alternative Investing. I'm here with my co-host David Kaufman, president of Westcourt Capital. Now, before the break, you heard David and I discussing various hedge fund strategies, as well as the difference between strategic and tactical investing. Here to add to that conversation is Martin Braun. He's president and CEO, also lead portfolio manager at Adderley Investment Management. Welcome to the show. Nice to see you.
Thank you very much.
So give us your history in the financial markets. You've been around a while.
Yeah, I've been around for 30 years. I started as a securities analyst for 7 years, and then I flipped over to a money management firm that went on to great things. I was fortunate to get in early. I was there for 10 years, and toward the end, I fell in love with the concept of the hedge funds, and I was unable to convince my partners to go with it, so I left to start my own fund, and it was launched in 2000, and we ran with that as a group, including a high net worth private client business. And for 7 years, we built that business to about $1.5 billion. At the conclusion of that period, we decided to split the business into two. The hedge fund business was spun out in a new vehicle, which is, as you pointed out, called Adderley. And it's now been 5 years, and Adderley is managing 4 funds. 2 of them are available to non-Canadians. 2 of them are available to Canadians, one for RSPs and one non-RSP, and the longest standing one is the 12-year record of Adderley Opportunity Fund.
And how much money under management right now?
We're in the 300 million mark.
All right, very good. And what kind of performance can you tell our viewers about that you've had?
Fortunately, we got off to a good start, and now in our 12th year, we are sporting something around an 18% net return compounded over that 12-year period.
Very good.
So you clearly did not achieve those returns just by having a long-only strategy. Before the break, we talked about the difference between single strategies and multi-strategy. Can you tell us a little bit about how it is that how you capitalize on different strategies at different times to be able to generate those kinds of returns?
Yeah, certainly. I think the primary philosophy that underlies everything we do is value-based. I started as a securities analyst analyzing companies, and that's been with me ever since. So it doesn't matter what strategy I adopt, I'm always thinking value. And the other thing that I've layered on as an extension of the value concept is spread investing. In other words, something, in my opinion, or the opinion of our company, is worth X, and we see it trading at a price noticeably below X, and we want to earn the spread between the two. Now, sometimes the spread is subjective because the value it's our opinion. And sometimes it's not that subjective at all, sometimes quite objective. In other words, let's say a company offers to buy another company for a set price. Well, there's no argument what the price is. And so when we started this fund 12 years ago, we did just arbitrage. Arbitrage, as I think you alluded to earlier, involves 2 companies merging and arbitrageurs or ARBs trying to earn the difference between what the price of the shares are and after the deal is announced and what the stated value of the deal is. Back in 1998, 9, and 2000, even into 2001, there were some excellent spreads available on deals that had already been announced, and we were cranking out very high returns, 20, 30, 40% annualized returns on deals that were already announced. Now, in the past decade, the spread on plain vanilla ARBs has narrowed and is no longer as attractive as it was back in those days. I guess too much capital has chased that lucrative opportunity, and the rest is predictable. But the basic concept of earning the spread has never gone away with us, and we're always looking for things that are trading at a discount, and we're always looking for a theoretical spread to earn.
Now, David earlier talked about the difference between a single strategy and multi-strategy. I understand that you're primarily multi-strategy, but just give us a general overview on single strategy versus multi-strat.
A single strategy would typically be within the confines of a mutual fund that has stated that it is clearly a Canadian equity growth fund or a U.S. large cap fund, and that's the strategy. And it's not going to change the strategy. It's part of a larger organization which offers multiple strategies through multiple funds, but not multiple strategies within one fund. In the hedge fund world, we're generally not part of large organizations. We're hardworking people who are around for quite a long time and are quite adept at employing various strategies at various times in the market. And so we house all these capabilities and strategies within under one roof in one fund, and we move from strategy to strategy within those funds as market opportunities dictate.
And you talk about I like this approach, the concept of spread trading, and it's not only with fixed income, it's with other types of mispriced assets. And as is the case with any so-called arbitrage, it will come to an end when other people discover it, as you just alluded to. So how do you, first of all, how do you have enough knowledge to be able to apply that in different areas? And then how do you decide where to go next?
Good questions. Hopefully after 30 years, I've got enough knowledge to tackle different strategies. Where to go to next is part of the secret sauce. We read like everybody else. We talk and network like crazy. We try to find people who know, and we try to pick their brains and combine it with other diverse opinions to come to our own conclusion as to who's more right than wrong. And on that basis, we work up themes and ideas. Sometimes we focus on a sector. Sometimes we focus on a stock. Sometimes we focus on the commodity arena. It's wherever the opportunity presents itself, and we just have to keep our ear close to the ground, or else we'll miss the opportunities.
And we hear about analysts who use fundamental analysis. We hear about analysts that are more quantitative, and then others who follow trends and momentum. Is a true multi-strat fund really a mix of all of those, and everything from reading the paper in the morning to calling people on the inside?
I think that's fair to say. I don't go to work in the morning with any preconceived notions as what's going to happen that day. Every day is a surprise, and I really can't predict what's going to happen within the next 24 hours. I just come to work with my eyes and ears open, and when something interesting hits the tape and it resonates with us, we push aside whatever we were working on, and we get to it.
Now, Martin, you were talking about some of your techniques. Could you give us more idea as to how tactical you are and time frames and things like that?
The time frames vary. I mean, we really are a composite of medium and long and a few short terms thrown in. The tactics range from the world of equities to the range of to the world of bonds and even options, derivatives. Tactics could employ long or long-short, pair trading as well, convertible hedging, which involves bonds versus stocks. And really, there's so many markets and so many sectors, it's really hard to encompass in a short answer all the different tactics we employ. But generally speaking, it's an opportunity fund that we manage, and the opportunity drive the tactics, not the other way around.
Okay, Martin, we'll take a short break here. We're going to come right back with Martin Braun of Adderley Investment Management. He's going to be back to tell us more about how hedge funds identify opportunistic trades.
David Kaufman is one of Canada's leading experts on alternative investing. He is the president of Westcourt Capital, a registered exempt market dealer.
Welcome back to Alternative Investing. I'm with David Kaufman, my co-host, president of Westcourt Capital, and we're joined again by Martin Braun, president and CEO, also a lead portfolio manager at Adderley Investment Management. Now, Martin, you alluded earlier in the show to how things have changed over the years. You've been in the business for quite a while. How difficult, or how has it changed in terms of trying to find that alpha, trying to get that difference compared to the way it was, say, 15, 20 years ago?
It's not as easy, in my opinion. Maybe I'm just getting older, but I find that there's just an enormous amount of information out there. The hedge fund industry has really exploded. A lot of very talented people have gone into the space, and one has to move very quickly in order to capture the alpha. There are some wrinkles today that are not as prevalent as in the past. There's a lot of research on insider activity, spin-offs, companies emerging from bankruptcies, in and around merger activities. There's so many publications and boutiques today that have dedicated resources to keeping us on the buy side aware of all these opportunities. So whereas in the past I might have come upon them myself, today we've got people out there that are selling their research to guys like us, and therefore I'm not the only one who gets in early. So
it's sort of like two sides to the coin, where on the one end you're getting a lot more information, but on the other side so is everybody else.
Yeah, and more guys like us have to craft our own deals.
Right.
I'm sure some of our viewers, all of our viewers, would like to get even more insight as to how you do things. And you gave us a really good anecdote before we went on. Maybe you could share that. It has to do with the BC and Nortel years ago.
Yeah, that was a very interesting play. Way back in 1999, there was a period when Nortel was controlled by BCE, and people felt that BCE shares were not getting full value for their Nortel holdings. And so a IPO was created called Teleclone to take advantage of the spin-off of Nortel that they felt at the time would eventually happen. Unfortunately, it didn't happen within the next few months, and the Teleclone idea died a quick death, and had lost people about 80–90% of their money until at some point the margin loan, which went with that equity issue, got pushed over to the case, saved Teleclone, at least gave them a line to carry on for a few more months. And on death's door, we were fortunate enough to buy Teleclone shares in the single digits, thinking that Nortel would eventually be spun out. It was a few months later. The stock went up 10 times within a few weeks.
And you hit a home run.
Yeah.
So that's a wonderful example, but of course that idea that seed had to be germinated from somewhere. So let's get under the hood a little bit. You come to work in the morning, you start to get just an idea about something being a potential opportunity. What are the steps that happen after that over the next minutes or weeks where you really develop that into an actual strategy and you think, this is where I'm going next?
The big thing is what do you need to have happen in order for the strategy to work? In that particular case, it made sense up until the point of Nortel being spun out or not being spun out. If it wasn't going to be spun out of BCE, then it didn't matter what the price is and what the thought process was. It wasn't going to work. We needed to convince ourselves that Nortel would be spun, and we just spent a lot of time over the next few days and weeks, even the next 2 or 3 months, convincing ourselves that it was inevitable. So no matter what the opportunity is, you still got to roll up your shirt sleeves and do the work.
And using the efficient market theory, the market prices a security. You decide that it's mispriced, so almost by definition, that's contrarian thinking. I guess you're comfortable going to work every day as a contrarian?
The easiest way to make money is to go the other way. And you never want to be in a crowded trade. That is typically a bad way to make money and a high-risk way to make money.
Now, you operate here in Canada, but you're also open to foreign investors. How would you assess the Canadian hedge fund industry and the strategies employed, and is it difficult to raise money here as well?
It's difficult for small hedge fund companies like our own to raise money. We're generally not aligned with large institutions or sales channels, and so we struggle to get bigger. Most of the money goes to the big guys. That's a trend that we've recognized in the States as well. The hedge fund industry also has a bit of a bad rap because people are attracted to its fee structure, and many of these people are either incompetent or dishonest, and that ruins it for everybody else. The vast majority of people in the business are honest. I'm not sure if the vast majority are really good, but again, when you have a high fee structure, it does attract all kinds of folks, and the fallout rate is fairly high among Canadian hedge funds.
And of course, the fee structure is not the only part of that that's high. Often the leverage is high, which is why some people refer to some Canadian hedge funds as levered long, which is what they really do is make big bets on mid-cap resource stocks and lever it up and have outsized returns in bull markets. Talk about how it is that you use leverage, when you would use it, and what the limits are there.
We rarely use leverage. I'm not a big fan of leverage. It magnifies volatility, and I hate volatility. It's hard to avoid, but if I employed leverage, it would make it even more obvious than it already is. So I try to get by with generating good returns without leverage.
And why don't we wrap things up by getting your views on the macro picture, because obviously you've talked quite a bit about micro, but you have to know everything that's going on. There's so many things happening right now. It's a very complicated world. Give us your take on Europe and the BRIC countries and so on.
It's a big question and probably best answered by a bigger man than me, but I'll give it a shot. I see it as a world of two worlds, with the emerging nations on a strong growth track and the more evolved Western nations like the U.S. and Western Europe on a very slow, stagnant track. And it's a blend of the two. What I do like is that S&P type companies, big multinational corporations, are shifting their business base and their profit streams to the emerging, to the high growth areas, and a greater and greater percentage of S&P profits, which, by the way, continue to rise, are coming from international operations. Not only are they growing fast, but they're also carrying higher margins.
And we saw what happened last year with the Greek debt crisis, where a country of 11 million people managed to move the markets around the globe with a potential sovereign debt crisis. There's been a lot of talk recently about the potential downgrade of U.S. treasuries. It may be unlikely, but if that were to occur, how would you position yourself to benefit from that event?
Again, I'm no economist, but my first response and probably my last response is to buy more gold.
All right. There we go. We'll wrap it up with that. Thank you, Martin. Thanks for coming in.
Pleasure.
Thank you.
Martin Braun of Adderley Investment Management. Nice to see you, David. We'll see you next week.
Thank you.
That is all the time we have for today's show. If you've got any questions about alternative investments, you can email us at alternativeinvesting@bnn.ca. Thanks a lot for joining us. We'll see you next time.